Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a company starting out on a small island nation, not just holding its own, but genuinely thriving against the giants of space. We're talking about a company whose stock shot up over 800% last year. They're landing billion-dollar contracts, making real breakthroughs in reusable rockets. Today, we're looking closely at Rocket Lab, and the big question we're tackling is this. Can this innovator actually hit profitability by 2026? Or will the fierce competition, the inevitable delays, will that keep them grounded? Stick with us, and by the end, you'll have a clear perspective, the insights you need to decide if Rocket Lab might be a portfolio rocket for you, or perhaps a risky burn. So to really get a handle on a company like Rocket Lab, you have to start with the leadership. Who's actually steering this ship?
Right, well, at the very core of Rocket Lab is Peter Beck. He's the founder and CEO. And he's quite remarkable, a self-taught engineer. His early experiments, literally in a New Zealand garage, laid the groundwork for what's now challenging major global players. His deep expertise in propulsion, it's undeniable. You see it in the results over 68 successful Electron missions by mid-2025. And they're boasting an impressive 98% success rate.
98%, that's critical.
Absolutely. That relentless focus on reliability is just paramount for their financial health. It minimizes those incredibly costly failures and, maybe more importantly, builds trust. It brings back crucial repeat clients, think NASA. Now, a really pivotal strategic move by Beck was accelerating the development of their bigger rocket, Neutron. That includes the recent partnership, just announced in July 2025, with Bollinger Shipyards. They're building an ocean landing platform.
Okay, so that's about reusability then.
Exactly. This isn't just about fancy tech. It's a direct play to slash Neutron's launch costs, potentially by 50%. That allows them to compete head-on in those medium payload markets where, frankly, even something like a Falcon 9 might be overkill, price-wise, for smaller loads. And Beck's push for vertical integration, bringing more and more operations in-house, that's also cleverly diversified their revenue streams.
How so?
Well, their space systems division things like satellites, components that now accounts for 70% of their income, and those systems carry higher margins, around 35%. This stable, higher margin income helps buffer the natural ups and downs of the launch business, and it helps accelerate that projected break-even point, aiming for 2026.
That dual focus integration and diversification sounds like a smart strategic move. But beyond Beck's vision, who's handling the money side and driving the tech innovation?
Good question. On the financial side, you've got Adam Spice. He's been CFO since 2018. He brings a ton of experience, managed huge revenues, $20 billion back at Broadcom. He's been absolutely vital in securing funding like that $355 million in convertible notes early in 2025.
Which keeps their options open.
Precisely. That kind of smart financial maneuvering helped them keep a healthy $517 million cash reserve, even while spending significantly on Neutron, about $200 million in capital expenditure. That strategy is crucial. It lets them weather potential delays, but still fund growth, scaling up to eventually rival the big players.
And on the tech side?
That's where Ervin Padabierman comes in, the CTO. He leverages his background from Boeing, from NASA, to really push the innovation envelope. Like the Archimedes engine for Neutron. They completed its critical design review back in May 2025. This engine is projected to be about 10 times more efficient. It positions Rocket Lab for potentially very lucrative interplanetary contracts down the line, which could fuel something like a 40% compound annual growth rate. So you see how leadership's strategic calls tied directly to that profitability timeline.
It really sounds like Peter Beck's personal drive is embedded deep within Rocket Lab's path. What are the implications of his continued hands-on influence?
Rocket Lab really is a textbook example of the kind of outperformance you often see with founder-led companies. Think SpaceX and Musk. Peter Beck isn't just a name on the door. He's central to every major decision. Everything from Electron's incredibly fast 48-hour launch turnarounds we saw in Q2 2025, right through to the long-term reusability plan for Neutron.
And his own stake is significant.
Very. It's over 12%, according to the 2025 proxy statement. That directly aligns his interests with investors, with you. In fact, his compensation is tied to hitting key milestones, things like achieving positive EBITDA by 2026. His real genius, perhaps, shone through in that pivot, moving from only small launches to the more ambitious medium-lift capability with Neutron. That shift saw the company's valuation explode from maybe $100 million in 2017 to around $25 billion by July 2025.
Yeah. This performance-linked structure means he's laser-focused on long-term wins, securing defense contracts, for example.
It allows Rocket Lab to compete incredibly effectively in niches where being agile, being quick, gives them a serious edge over sheer size. This approach could let them grab, say, 10–15% of that projected $41 billion total launch market by 2030.
So a very strong founder-driven team. How does this translate into Rocket Lab's overall mission and the kind of culture they've built?
Their mission is sharp, it's clear. Democratize space access for Earth's benefit. And that's not just talk. It's about absolutely. The culture emphasizes innovation, alignment. You hear terms like rapid iteration. That July 2025 48-hour relaunch cycle. That's a perfect example of how their team, over 1,500 employees, are focused on these objectives. This approach cuts down on the kinds of delays that have really plagued some competitors. It fosters efficiency. You saw that in the 32% revenue jump in Q1 2025. This intense focus helps minimize Neutron's risks and builds a strong competitive advantage, especially for those rapid responsive missions.
That's a compelling vision. Okay, let's shift gears a bit. How does Rocket Lab actually function day to day? Can you break down the business model for us?
Right. Understanding Rocket Lab's model. It's a bit like decoding a high-stakes delivery app, but for space. At its core, it seems simple. Launch satellites affordably. But the layers are complex. Think about achieving pinpoint orbital accuracy with all the traffic up there now, or engineering rocket reusability that's way harder than just landing a plane.
So like a specialized courier for space.
That's a good way to put it. UPS for orbits? Maybe. Electron is their nimble van for the small stuff, costing around $7.5 million a launch. But the tricky parts involve things like global supply chain risks, regulatory hoops, like Neutron getting its crucial FCC license just this July. Neutron, then, is the big rig, the semi-truck for the bulk hauls. It's specifically designed to undercut the larger ride shares, which are often flying with spare capacity. Profitability for Neutron isn't guaranteed, though. It really hinges on them hitting 20-plus launches a year by 2027, and doing that even if inflation keeps squeezing margins.
That makes sense. So within that model, what are the specific products and services they're offering?
Well, Electron has definitely found its sweet spot. 68 launches by July 2025, employing 232 satellites. Clients include NASA, the DoD. It offers dedicated orbits, that 98% success rate we mentioned. That success really drove the 32% Q1 revenue growth, getting them to $123 million.
And Neutron is the next big step.
It is. The roadmap is exciting. Debuts expected in the second half of 2025. It's built for larger 13-ton payloads, really targeting those big constellation deployments. Each Neutron launch could bring in $50 to $55 million in revenue. And that recent Bollinger deal for landing platforms, that's a huge boost for Neutron's reusability.
But you said it's not just launches anymore?
Correct. Their space systems business is huge now. Things like the Photon spacecraft used for lunar missions and solar cells used in over 1,000 satellites. That division now makes up 70% of their revenue. And these systems clearly have strong market fit. Look at the $515 million contract with the SDA, the Space Development Agency. Plus those recent quick turnaround Electron launches in July, the 67th and 68th within 48 hours. That helped push their backlog to $1.06 billion.
Which is crucial for cash flow.
Absolutely. It stabilizes cash, supports that path to profitability. Those government deals especially act almost like annuities. Consistent income, that helps them compete effectively in those very specific high-precision niches.
So it's really a whole space ecosystem they're building. What makes Rocket Lab truly unique in this incredibly competitive field?
What really sets them apart is that unique blend. Deep vertical integration, remember, about 80% done in-house. Combine that with a passion for agile access and those strong economic drivers like the high-margin space systems business running at 35% margins. This end-to-end control from manufacturing right to orbit lets them excel in rapid deployment compared to rivals.
Can you give an example?
Sure. That $515 million SDA contract for 18 spacecraft? Rocket Lab's model essentially halves the delivery timeline compared to relying on separate, bulk-focused providers. Or think about NASA's capstone mission to the moon. Rocket Lab launched that using Photon for just $10 million. Alternatives were likely $50 million or more. That showcases a massive cost advantage, and those cost efficiencies are absolutely critical for hitting profitability by 2026, especially as they target those underserved small and medium parts of that $41 billion market.
They definitely have a strong identity. Could you walk us through their track record and where they operate globally?
Okay, track record. Since their first orbital launch back in 2018, key milestones include over 60 Electron missions now. There was that significant pivot after COVID, shifting focus more heavily towards space systems, now 70% of revenue. And of course, that record 48-hour turnaround in July 2025. That was impressive. They've also adapted strategically, acquiring companies like Sinclair for key components. That helped grow the backlog to $1.06 billion. In 2024, they did 16 launches, that's 60% year-over-year growth. It brought in $436 million in revenue, a stunning 78% growth. Their ability to reinvent and execute amidst disruptions like inflation really positions them well for 2026 profits and lets them dominate specific niches effectively.
And physically, where are these operations located?
Their headquarters are in Long Beach, California. They own their R&D facilities there. The launches, they lease pads. Complex 1 is in Mahia, New Zealand. Complex 2 is at Wallops, Virginia. On the manufacturing side, they own the Neutron factory in Maryland, and they have component manufacturing in Auckland, New Zealand, too. By keeping so much in-house, minimizing outsourcing, they significantly boost efficiency. That's key for their financial goals.
That vertical integration really does sound like a core strength. How does controlling so much translate into financials and competitiveness?
Well, controlling everything from engines to software, it demonstrably cuts costs, maybe by 30%. That Neutron platform deal is a prime example of leveraging this. It makes them much more efficient compared to competitors who often face significant delays. And the impact is real. Faster turnarounds, like that 48-hour cycle, that leads directly to better margins, helping path to that 2026 break-even target. And it gives them the agility, the speed, to compete effectively, even against much larger players in their chosen segments.
How do they keep the business coming in? What's their distribution model like?
They use a very effective direct contract model. They also have specific online portals for customers looking for rideshare opportunities. They've innovated with really fast 15-day launch cycles, which is attractive, and they boast a remarkable 90% customer retention rate. That model supports steady, consistent growth. It often lets them be more flexible than larger competitors for small launches, which is vital for their profitability.
And revenue predictability. How stable is their income?
Pretty stable, actually. Around 56% of their revenue is recurring. That comes from long-term deals like that big $515 million SDA contract running through 2027. And that huge backlog, $1.06 billion, that's 2.4 times their current annual revenue. That significantly helps narrow losses and build stability towards that 2026 goal. It offers much more revenue predictability than some larger competitors might have, relying more on single large missions.
Okay, solid operational base. But in this industry, with such a dominant player, how do they build a real competitive moat? What protects Rocket Lab?
That's the core question, right? How do they defend their turf? Rocket Lab builds its moat on several key pillars. First, strategic niche domination and those regulatory barriers. They control about 60% of the U.S. small lift market. Plus, FAA hurdles and their existing patents offer significant protection. This near monopoly in dedicated small missions lets them keep premium pricing.
Which funds the path to profit?
Exactly. As that $1.06 billion backlog grows, it's very different from larger players who have huge overall share, but less grip on this specific small niche. Peter Beck's move to Electron back in 2018, that filled a gap others ignored. They turned regulations into market share.
What else forms that moat?
Second is their vertical integration and tech leadership. Controlling everything, from their patented 3D printed engines to software, cuts costs by 30% and drives rapid innovation. Neutron's Archimedes engine, promising 10x efficiency. That's proprietary tech. The July CDR completion was a big step.
Setting them up for a profitability leap.
Potentially, yes. This in-house capability, plus access to top NASA talent and big DoD contracts like that $515 million SDA deal, lets them attract great engineers. That strengthens their long-term edge. Their internal processes yield strong 30% margins, hard to copy after years of refinement. Those rapid Q2 launches show the cost and quality edge.
Okay, so niche dominance, tech leadership. What else?
Third is agile operations and strong customer lock-in. Their ability to launch dedicated missions, sometimes within 48 hours. That directly counters the potential delays you see with big shared rides. Customers praise their precision look at the capstone mission's success. That builds deep loyalty, supports higher margins. They focus on winning where bigger players might over-engineer. Plus, switching costs are high for clients, millions in reintegration. That locks them in.
Creates recurring revenue.
Exactly. Custom payloads create barriers. Deals like the SDA contract mean steady cash flow towards that 2026 break-even. Finally, their brand and market timing have been spot on. That 98% success rate builds huge trust, allows for a 10-15% price premium. Peter Beck's story resonates, fosters loyalty, gives them pricing power. You see it in the backlog growth. Electron hit the small sat boom perfectly. Now Neutron is time for the 2025 constellation wave. They're optimizing trends larger players started. And their speed, those 48-hour turnarounds, actively discourages rivals. It optimizes their supply chain, give them a real edge over slower competitors.
That's a formidable set of defenses. How sustainable do these advantages look long term, and what could potentially chip away at them?
Well, assuming Neutron delivers these advantages, the patents, the integration, look sustainable for 10 years, maybe more. Their innovation culture also helps perpetuate this, but the risks are real. Biggest worries: neutron development delays dragging into 2026 or later, unexpected new competitors popping up, or rapid tech leaps from rivals. And you always have those broader economic factors, inflation, supply chain issues, amplifying the pressure on their timeline.
So, strong advantages, but real risks. With that in mind, what's Rocket Lab's strategy for ongoing growth, and how resilient are they?
Their growth strategy is multifaceted. They plan to push Electron deeper into the market, aiming for 20-plus launches in 2025. Simultaneously, they're developing Neutron to tap into completely new, larger markets. And they keep enhancing their space systems, like a satellite platform. Key growth drivers: expanding defense contracts, already half their revenue. Breaking further into Europe via ESA deals, they're projecting a hefty 40% compound annual growth rate from new contracts, that July-Bollinger partnership. That directly speeds up reusability, which is vital for constellation growth.
Where's the biggest growth potential you see for them?
The most significant upside seems to be in Europe, through those ESA missions and, critically, with Neutron. Neutron is a serious contender for the huge National Security Space Launch Program, the NSSL. Winning even part of that would be transformative. More growth could come from strategic M&A, like the Bollinger deal. Now, there's maybe a 20% chance of delays hitting Neutron, but the rewards, if they execute, are huge. Potential for 50% growth, maybe mirroring the early path of giants like SpaceX, driven by delivering on that massive backlog.
What's the total size of the market they're playing in?
The whole launch services market is set to grow substantially, from around $15.2 billion in 2025 to potentially $35 billion by 2030. Within that, small launches may be $5 billion, medium is $10 billion, and space systems is a huge $20 billion piece. Rocket Lab is positioned strategically to capture a good chunk, maybe 10–15% of that total market, through Neutron and their diversification.
And what kinds of things is their technology used for?
The applications are really broad, which is a strength. Spanning critical defense work like HASTE hypersonics, communications, deploying those big satellite constellations, even deep space exploration, like their Venus mission plans. That versatility suggests resilience. They're not tied to just one market segment, which helps if one area slows down.
How robust is their supply chain?
They focus heavily on U.S. and New Zealand suppliers, plus that 80% in-house production. That mitigates a lot of common supply chain risks. There are still some vulnerabilities with certain imports, sure, but strategies like local manufacturing provide a pretty strong buffer against disruptions, makes them more resilient.
And their customer base? Is it spread out enough?
Yes, it's impressively diverse.
Yeah.
About half are government clients, NASA, DoD, which are very stable. The other half are commercial customers, and they operate across the U.S. and Europe. That geographical and client diversity really helps stabilize revenue through those long-term contracts, minimizes reliance on any single source.
What's their long-term outlook in this fast-changing industry?
I'd say they have a very high probability, maybe 90% of long-term viability, especially when you consider the whole space economy is projected to hit $1 trillion by 2040. They're incredibly well-positioned to ride out economic downturns, thanks to those government annuities and the powerful secular trends, growing constellations, direct-to-device comms.
So, main growth drivers moving forward.
Primarily Neutron success, landing those new contracts reflected in the $1.06 billion backlog, and the continued strategic expansion of their space systems business.
And the biggest hurdles to that growth?
The primary risks remain potential Neutron delays, the sheer dominance of players like SpaceX, and maybe market saturation in small launch if too many competitors jump in.
Looking beyond Rocket Lab itself, what external macroeconomic factors could really sway their path?
Rising interest rates are definitely a factor. They increase the cost of servicing Rocket Lab's $490 million debt. That could put pressure on the $200 million needed for Neutron's CapEx, potentially delaying that 2026 profit target if borrowing costs keep rising.
What about global trade tensions? They seem constant.
They can disrupt imports for certain components, yes. But Rocket Lab's focus on U.S. operations actually helps their expansion efforts. And paradoxically, these tensions can sometimes boost government contracts as nations prioritize domestic capabilities. So a mixed bag there.
Inflation. That's hit everyone.
Inflation is a definite concern. If material costs jump, say, 15%, That could squeeze their current 29% margin significantly. Makes it harder to find the cost savings needed to hit break even.
Any macro factors unique to Rocket Lab or the space sector?
Well, the geopolitical space race is a net positive for them, boosting government contracts like the Golden Dome Initiative. But a broader economic slowdown could definitely delay commercial space ventures. Tariffs might help them against foreign rivals. But really, the inherent volatility of this rapidly growing trillion-dollar potential space economy always adds a layer of uncertainty.
Okay, let's get down to the numbers. What does the current financial picture look like for Rocket Lab, pulling all this together?
Right, the financials tell that classic growth story. Invest heavily now for big returns later. Q1 2025 revenue hit $123 million. That's strong top-line growth, up 32% year over year right in the space boom. But they reported a net loss of $60.62 million. That clearly reflects the major intentional investments going into Neutron.
So spending money to make money, essentially.
Exactly. Scaling launches fuels the top line, but CapEx weighs on the bottom line for now. Gross margins were 29%, up 3 points, showing they are getting more efficient. The Rule of 40 metric, combining growth and margin, is at 62%. That's strong, suggesting smart investment, even though return on invested capital is negative while Neutron gets built. Cash balance looks healthy, $517 million against $490 million. Debt to equity is reasonable at 0.8, gives them a buffer. Free cash flow is negative $50 million, but importantly, it is narrowing.
And the backlog is key here.
Absolutely crucial. $1.06 billion backlog. That's 2.4 times current revenue signals strong future predictability. And don't forget that 98% launch success rate. That's a benchmark for reliability. Context matters too. Their Q2 guidance is $140 million. That implies about 10% sequential growth, which is pivotal for that 2026 profitability path.
How do these numbers compare to others in the space industry?
Their 32% growth rate is faster than many competitors, although still behind the sheer scale of SpaceX's growth. But where Rocket Lab really stands out is that backlog strength. It provides predictability that contrasts sharply with the volatility you see with many peers. It highlights their resilience.
What trends do these financials show about their path to profit?
The trends are definitely positive. Revenue surged 78% in 2024. Margins have been improving steadily about 5 points a year. If that holds, it strongly suggests 2026 break-even is feasible. But it's tight. Any significant Neutron delays can definitely push those losses out further.
Let's bring it right up to the present day. What recent events and chatter are shaping how people see Rocket Lab right now?
Okay, very recently, July 14th, that Bollinger Partnership for Neutron's ocean landing platform was announced. Big boost for reusability efforts. Their Q1 earnings actually beat expectations. $123 million revenue versus estimates of $121 million. And they just completed their 68th launch this July. Looking ahead, Q2 earnings are August 7th. Guidance is $140 million. Everyone's waiting for Neutron updates. They're also bidding on SDA Tranche 3 contracts, which are significant. And Neutron's debut is still slated for the second half of this year. So the market's watching closely for any hint of delays or news of major contract wins.
And what's the general feeling, the sentiment around Rocket Lab among investors?
As of mid-July, looking at various platforms, sentiment is running about 80% positive. Lots of buzz about the stock potentially breaking $50, plus Neutron being the key catalyst for 2026 profits. And their ability to compete well in those niches. You even see some predicting no major dips, even if minor delays happen. They're very bullish. The other 20%. Concerns mostly focus on valuation, is it too high already, and the risk of Neutron development slipping. But for most investors, the priorities are clear. Execution, execution, execution. And landing those contracts. Bulls point to rapid growth, profit potential. Neutrals question the long-term competitive fight. Overall, strong optimism about growth and maybe being undervalued, but definitely tempered by awareness of the risks. Filtering out the hype is key.
Okay, with all that context, let's talk valuation. Where does the stock stand now, and what does that price tag tell us?
As of July 18th, 2025, the stock's trading around $51.12.
In a volatile sector like space, how vital is building in a margin of safety?
Oh, it's absolutely critical. Margin of safety means trying to buy, say, 20–30% below what you think the company's actually worth. It's intrinsic value. It's your buffer against that inherent space sector volatility. A Neutron delay could easily knock 20% off the stock price overnight. Margin of safety is your main defense against overpaying when excitement is high.
Why does valuation matter so much for a company like Rocket Lab specifically?
Valuation is paramount because it tells you if the market price reflects reality. Is it undervalued or potentially overvalued? That directly impacts your investment choice. For Rocket Lab, it's about judging if that $25 billion market cap is justified by the growth potential, or if it's showing bubble-like signs compared to, say, SpaceX nearing $400 billion.
How do analysts typically value Rocket Lab?
Well, one way is intrinsic valuation, like a discounted cash flow DCF model.
Right.
If you assume maybe $2.6 billion revenue by 2029, apply a 25x price to sales multiple.
Yeah.
That could get you to a $65 billion market cap.
What?
And it's a big, but that heavily depends on Neutron being successful and on time. Looking relatively, Rocket Lab trades around 49 times sales. Peers are closer to 9x. SpaceX is way up near 100x. So Rocket Lab's priced for high growth, clearly, but not quite at the level of the undisputed leader. More complex analysis might paint scenarios, a bull case, Neutron on time, perhaps reaching $75 a share, a bear case delays, maybe down to $30. For growth stocks like this, often a hybrid approach works best, factoring in things like that big backlog multiple too.
Can you break down the core arguments for the bear case and the bull case on Rocket Lab?
Let's start with the bear thesis. Big institutions worry about significant Neutron delays pushing past 2026. That could really erode their edge. They're currently losing $60 million, no positive free cash flow yet. That's a concern. And then there's SpaceX. $15.5 billion profit, 95% market share. Some fear they could just overwhelm competitors. Valuation is another bear point. 49x sales looks bubbly to some. What if Q2 earnings miss guidance? Could see a 50% drop. Individual investors echo this. Is SpaceX just too far ahead? Is Rocket Lab overvalued before profits? Are delays almost inevitable? The full bear case emphasizes a cash burn from CapEx, $200 for Neutron, fierce competition, inflation pressure, maybe small launch market saturation. That 361% rally in 2024. Unsustainable without perfect execution, they argue.
Okay, that's the cautious view. What about the bulls?
The bull thesis predicts that explosive 40% compound annual growth rate, hitting $2.6 billion revenue by 2029, driven by Neutron, bringing in maybe $50 million per launch. They point to the $1.06 billion backlog, the smart diversification into systems, 70% revenue now, as huge positives. Analysts generally see profitability by 2026-2027. They believe Rocket Lab can effectively challenge SpaceX in specific niches, having already grabbed 60% of the U.S. small market. Institutions look at the trillion-dollar space market projection by 2040 and see Rocket Lab's contracts filling a valuation gap compared to other big players. Many individual investors see huge potential, maybe a 10x return, and are buying more. Catalysts like Neutron's first launch, growing constellation revenue, they think these could make the stock soar. Huge faith in Peter Beck's leadership. The full bull case highlights the proven track record on 68 launches, the strategic Bollinger deal, potential government favor like Golden Dome, and argues the company is undervalued given its potential to grab 10-15% of the total market. They believe strong execution and the backlog outweigh delay risks.
Considering both sides, is the stock currently a bargain? Is it trading at a discount?
At $51.12, no, I wouldn't say it's at a discount right now. It seems to be trading at a premium, even compared to the more probable bull scenarios. While the intrinsic value might suggest some upside long-term, the current market enthusiasm means there's a real risk of a pullback. So generally, not seen as a bargain. It might be wise for you to wait for a potential dip, maybe post-earnings, especially if any delays surface.
We started off asking, can Rocket Lab, this one small startup, actually achieve profitability while taking on the market leader? After covering all this ground, what's your conclusion?
Yes. I believe Rocket Lab absolutely has a robust, clear path to profitability. It's driven by Neutron's reusability, those 50% cost cuts, $50 million per launch potential. It's driven by their strong space systems segment, 70% of revenue, 35% margins, consistent income. And that huge $1.06 billion backlog provides significant revenue predictability. The most likely time frame, 2026 to 2027 for profitability. Analysts see positive cash flow by 2026, maybe the first profitable quarter in late 2026, but it hinges critically on hitting that Q2 guidance, 130, 140 M, and Neutron debuting in late 2025 without major setbacks. The evidence supports it, 32% Q1 growth, 78% revenue jump in 2024, those rapid July launches showing execution muscle.
And can they genuinely compete with a giant like SpaceX?
Yes, over time. Specifically in those small, medium niches where they focus. They already dominate 60% of the U.S. small market, in a segment where SpaceX is actually less focused despite its overall 95% share. Rocket Lab's agility, those 48-hour turnarounds, their strong defense focus, HASTE hypersonics, strategic diversification, these are key differentiators. While SpaceX rules heavy lift, Rocket Lab's 40% 6C AGR projection puts them on track to capture 10-15% of that $35 billion total market by 2030. Innovations like the Bollinger platform help, their track record 68 launches, strong moats, integration patents, and riding secular trends like satellite constellation growth, these significantly outweigh the delay risks, which currently look like maybe a 20% chance of pushing profitability to 2027. Peter Beck's journey, garage to global challenger, positions them for success if, and it's a big if, execution stays consistent. Boiling it down, there's maybe some asymmetric information here. The DoD wants to diversify away from a single launch provider. That makes Rocket Lab's contracts incredibly valuable, acting as powerful moats the market might undervalue.
That backlog signals potential growth not fully priced in. On the risk side, the known unknown is Neutron delays maybe a 20-30% chance of slipping into early 2026, which would hit that 40% growth rate. The unknown unknowns. Geopolitical shocks, trade wars, sudden tech breakthroughs by rivals for you, the individual investor. Keep a close eye on Q2 earnings. For any beat on guidance, that could be a key signal.
We've traced Rocket Lab's incredible path, visionary leadership, unique model, strong advantages, financial resilience. We've weighed the pros and cons, landing on a clear though challenging path to profitability. The space industry is moving incredibly fast, and companies like Rocket Lab aren't just passengers, they're helping steer the course. As you think about all this, consider the bigger picture. What does democratizing space access truly mean? How might cheaper, more frequent launches reshape our world, creating opportunities we can barely conceive of today? This is really just the start of understanding the immense potential waiting beyond our atmosphere.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.